Good morning. Welcome to IA Global Asset Management's quarterly podcast, where our portfolio managers and asset class experts discuss current market events, trends, portfolio allocation, and outlook. I'm Rose Marcello. I'm a client portfolio manager with IEGAM, and my guest today is Maxime Houde, portfolio manager, thematic investments. Maxime has been a key player in the US thematic strategy since 2017, and today he leads the strategy with the support of two analysts. Good morning, Maxime.
Good morning, Rose. How are you?
I'm doing good. Thank you for being here. Uh, what I'd like to discuss today is the fact that the AI trade seems alive, but some spots brighter than others. So I'd like to talk about which sectors have struggled a bit more since the beginning of the year. Why is that? The change in momentum maybe for earnings growth, as well as your outlook for US equities for the second half of 2024.
Yes, absolutely. Let's dig in. So yeah, the AI trade has been front and center to start the year. Most of the outperformance has come from AI beneficiary over the start of the year. One area that is quite interesting is that as we move further down the second half of the second quarter, I would say we've seen some profit taking in some areas that came on the back of Dell and Micron that had some good result, but that were a bit below buy side expectation, and so following that we had some weakness in Nvidia. It's still a company that will highly benefit, but it's just company had run so much that there's some profit taking there, and people are starting to look at other area of the market where there could be more opportunity. One area that may be surprising that has highly underperformed this year is really software in technology. Even if technology is one of the best sector this year, software is not. The reason for that is that Q1 results were a bit lackluster and guidance were for a lot of company below expectation, and that came from two parts, I would say. The first one is that as we exited Q4, there was a lot of momentum and spending was quite strong. That didn't flow through Q1 and even Q2. So company were a bit surprised by that. The main reasoning is that most of enterprise right now are focusing and preparing themselves to adopt AI software. And the main beneficiary of that is hyperscaler companies, so Google, Microsoft, and Amazon. So what we've seen is the pie is growing, but most of the budget is taken by those companies, leaving the rest of software with less IT budget for them. So that's been an area that has highly underperformed to start the year.
So some sort of consolidation with the big names and the big leaders.
Yes, actually, if you look at the contribution to performance from the top 10 company in the S&P 500, it's the second most concentrated year ever. The only year that was more concentrated than that was actually 2007. So it's really a small number of company that is generating all the revenue, all the profit so far this year in terms of market performance.
Speaking of profit, so I'd say we can see that the momentum in earnings growth has intensified. How do you think this will affect returns for US equity in the second part of the year?
Yeah, it's definitely going to be interesting. One of the reasons why we were extremely positive and bullish on hyperscaler on the Magnificent Seven was because their profit growth was way above the rest of the market, and that was at an interesting valuation. But as we move to the end of the year, what gets really interesting is that if we compare the earning growth from the Magnificent Seven versus the rest of the S&P 500, there's going to be a convergence between the two, where both of them will grow roughly at the similar rate. So we do expect that there's going to be a bit of a market rotation because of that. We do still believe that technology company that's benefit from AI will continue to perform well, but we do believe that we're going to see some interesting opportunity elsewhere, which company that have lower valuation would be able to grow their earning at the same pace. So we do expect this phenomenon to bring a bit of a market rotation, but that's going to bring breadth of the market, so that's going to be healthy overall.
Interesting. So maybe if we look at the remainder of the year, we're already like starting July or early July as we record this. What are your expectations? What's your outlook? Any significant risks that are looming on the horizon?
I think on the macroeconomic level, we still need to follow inflation. Obviously, it came down, but not at the pace that we were expecting it to come down. So still a rebound in inflation would be problematic for the market. We need to follow GDP growth and overall economic data. But I'd say the most important one for us is really looking at the election and the outcome from the election. That's going to be the main focus until November, and that's what we believe will move the market the most.
Speaking of the US elections, actually, any specific concerns or are there opportunities for which you have strategically positioned the mandate as we go into November?
Yeah, I think we took some action, especially following the debate last week. Look, it's been a difficult debate from the Democratic Party. That was not expected. And I'd say now, I think we can, it's still early, but we can say that Trump seems to have a lead in this run up to the election. There's multiple implications from a Trump presidency. We know he wants to reconduct tax cut, which would be good for the market overall. But we need to look at the counterpart of that, where he has a tariff plan for China with a 60% tariff, and then you want to impose a 10% universal tariff overall. So both of them would be inflationary. It's important to put a caveat on timing of that, and also the 10% universal is something that is extremely difficult to see how we can implement that. But overall, there's a risk of some inflationary pressure. Other area to look at is really, we know that he will probably want to repeal some part of the Inflation Reduction Act, so the IRA. So that's one area where we took some action. We had investment in renewable energy that would benefit from AI. That did really well. We took some profit there because if we would see a repeal from the IRA, that would be highly negative for those companies. And we already have seen some price action reflecting that. The other part is that there is a possibility that he would try to repeal also the Affordable Care Act. That would be good for managed care overall. So we took action also on that front. Where we look that could be really interesting also is, we know that usually Republican government, and especially Trump, is more loose on regulatory capture. So that should be a good environment for M&A. That should be good for big technology company that could do M&A, which was impossible under Democratic Party. As we remember, we just need to look at Amazon that tried to buy iRobot and that got sued by the FTC. So that's the type of thing that we do think would not happen under Republican leadership. So M&A would be good for them, and that would also be good for small cap. Tax cut would be good for small cap. They would be the target for M&A. And then if we look at the back end of the year, rate cut will also be super good for a small cap. They're right now trading at a pretty low valuation. So that's an area of the market that we're more and more interested in, see a pretty big opportunity. But overall, we do expect to see breadth taking place in the market, and a broadening of market participation, and not just the top 10 company contributing to return. And obviously, like past election cycle, there's going to be some volatility. Usually we have a pickup in volatility starting in July. So that's going to take place, we do believe, but that's a good environment for stock picking and an active portfolio manager like us.
Exactly. So you're going to have a very busy fall, I can see.
Absolutely.
Well, thank you so much, Max, for being here today. Always insightful to speak with you.
Thank you, Rose.
Thank you. Bye.